Welcome to Geojit Spotlight. The Indian equity markets witnessed a mixed bag of emotions in 2025, supported by strong domestic fundamentals, but negatively impacted by global policy issues as well as geopolitical issues. We witnessed a little bit of market volatility with small phases of corrections, if I may say so, especially depending on the market cap that you were invested in. To talk about the year ahead, in 2026, key questions arise regarding the momentum in the markets, regarding the policy issues, regarding the rate hikes. To discuss all these dynamics, we have with us Dr. Vijayakumar, Chief Investment Strategist of Geojit Financial Services. Welcome, sir. Welcome to this session.
Thank you, sir.
I remember maybe a year back exactly, when we were talking about the outlook for 2025, you were mentioning about the Indian stock markets, watering down expectations from the markets, and I think we've almost seen that, we've seen the benchmark indices maybe giving around 9% returns, but the broader markets which have significantly underperformed. So if I would ask you to rate yourself on your predictions, where would you rank yourself out of 10, with regards to what you said in the end of 2024, how would you rate yourself?
In rating in colleges, I taught in college for more than 30 years. The number rating has been replaced by grade.
Okay.
C, B, A plus like that. So there is no point in rating with numbers. And I will leave the rating to the audience, let them rate. Regarding the projections that we made in the video that we did last year, well, you used the correct expression, watering down expectations. That was my intention also. That's why I said in that interview which we did a year back, that expect only moderate returns. Moderate was the word used. Don't expect the kind of returns that you got during the last 4 years. That was in a special context of COVID crash, economic recovery after that. So expect only modest returns, moderate returns. And I'm happy to see that I would have been happy if the returns had been higher, but then that projection has come true. If you take the year till date return in 2025, and I'm talking about year till date return, I'm talking about the returns till December 20th. Nifty has given 9.5% returns. But Nifty small cap, yes. As you said, the broader market has disappointed. Nifty small cap has delivered minus 8.5% return. So whether you gained or lost depends on where you invested. Exactly. And we had again mentioned in that interview that large caps are safe, mid and small caps are a little bit overvalued, particularly small caps are overvalued. Therefore, you have to be extremely careful while investing in small caps. Not only in that interview, in the videos that we did, many videos that we did in 2025, this precaution to be taken while investing in small caps, that was emphasized. Coming to the projection for 2026, well, in stock market we always say that 1 year is too short a period of time. But since we are on the eve of the new year, well, the next 1 year makes a lot of sense. I would say now, taking a little bit risk, that 2026 will certainly be better than 2025. You can upgrade your expectations from moderate to a decent returns. Let us say 12 to 15% returns can be expected.
This is in large caps, the benchmark indices?
Benchmarks, yes, benchmark. Since you talked about benchmark, I would say that in a bull case scenario, Nifty at 30,000 is achievable in 2026. Of course, things can go wrong, but then in the current context, as you said in your introduction, there are many fundamental factors falling in place. positive factors. So that is possible. So I upgrade my projection for 2026 to decent projections from moderate projection of last year.
Right. So in 2025, let's talk about the global backdrop as such. We saw a lot of heads of states, coming together. So I was just wondering if there is a politicization of the stock markets, because we saw the whims and fancies of, let's say, the US president, the stubbornness of the Russian president, and, the diplomatic outreach of our own Indian Prime Minister, wherein we had a diplomatic outreach to a lot of countries. So, do you think this is impacting the stock markets a lot more, and what do you see for the next year also?
Well, these things, let me borrow your words, the whims and fancies of the US president, the stubbornness of the Russian president, these did impact the market in 2025. We know the markets reacted very sharply to the reciprocal tariffs, which came like a bolt from the blue. And also the stubbornness of President Putin was also not unexpected. Not expected, rather. He was unexpectedly stubborn, even with thousands of people dying. So these things can impact, but then the lesson that we have to learn is that the market reactions to these political decisions will be only short term.
Right.
So what happened to reciprocal tariffs? Right. The sharp market reaction, and how the market...
So that is where I was mentioning, we had these phases of correction also in the market. Not a correction as such, but, the reactions to all these...
Yes, such reactions will be there with people like Trump and Putin around, and with the recent adventures of Trump in Venezuela, right? Well, there won't be any boring days in 2026. There will be a lot of adventure, and the market will react. But the market reaction will be short-lived. In the long run, as we know, the market direction will be dictated by earnings. I always tell the investors to remember Benjamin Graham's famous quote: the market in the long run is a slave of earnings, not the slave of remarks or comments by Donald Trump or President Putin, because these are not permanent people, right? These are not permanent people. Another term for Donald Trump is constitutionally impossible, right? Whereas market companies, earnings, they will still be there. So don't bother too much about the market reactions to this. In fact, smart and shrewd investors can utilize these potential corrections that can happen in the market in response to these comments as a buying opportunity. Just as the reciprocal tariff and the market crash consequent to that was a buying opportunity. We had said in our interview, these are buying opportunities for long-term investors.
Coming back to the domestic scenario, we've seen a lot of support for the markets, especially because I think the domestic fundamentals was one thing that held up the markets over the year 2025. So what is your analysis on that? Will we see a lot of help from the government and the RBI? I know it's too early to talk about the budget as such, because but that is something that will definitely provide support to the markets. So where do you see the government, the policies that they've been taking? How would you rate that, and how would you see that in the coming days?
Well, the resilience of the market today, as we speak on 22nd December, Nifty is about 26,100, the last time I checked, near the all-time high. It appears that the market is heading towards a year-end rally, which can take it to newer highs possible. Now, much of the resilience of the market is, as you rightly pointed out, due to the strong fundamentals of the economy. Despite Trump tariffs, we are likely to grow 7.3% this year. And FY27, I won't be surprised if the 7.3% GDP growth is repeated in FY27. It can even go to 7.5%. If we have a favorable US-India trade deal that has been hanging fire for quite some time, but then there is a limit for everything. It is likely, if all these things fall in place, another 7.5% GDP growth in FY27 is a bull case scenario that is likely to be having a very favorable impact on the market. Regarding the policy stimulus given by the RBI and the government, frankly, I have always argued for strong stimulus by the RBI as well as by the government. But to be honest with you, I did not expect the kind of strong stimulus which the RBI delivered, particularly under the new RBI chief, and also the fiscal stimulus delivered by the government, not only through the very path-breaking tax relief provided in the last budget, but also, perhaps more importantly, through the GST rationalization and the GST cuts, which have provided a big boost to consumption in India. So from the policy stimulus angle, the government delivered in calendar year 25, and we are continuing with policy reforms in labor code and all that has already happened. You can expect more reforms going forward, because economic reform is an ongoing process. It is an ongoing process.
So safe to say that the government and the financial institutions are on it. They are still working to work the economy. There has been a lot of commentary regarding the valuations that the Indian equities were garnering. But a recent talk has been that there has been a valuation reset in terms, and you were also mentioning that the focus should be on the earnings and the earnings trajectory. So has that focus shift happened, in the sense that, of course, we were commanding high valuations earlier, but now the valuations have tempered down, and are investors really looking at the earnings of the company? And that could be one of the reasons wherein we saw the large caps, specific sectors, specific stocks outperforming while others were laggard. So has that shift happened in the Indian markets?
Partly, not completely. It has happened partly. It has tempered, as you said. But even if you look at the valuations presently, as we talk now, the Nifty is trading at around 22 times. I'm talking about trailing earnings, not 1 year forward earnings. So Nifty P is around 22, slightly more than 22. We can say it is more or less in tune with the long-term averages. What about mid caps and small caps? Nifty mid cap is trading at 33 P, and Nifty small cap, I'm talking about Nifty small cap 100, at 31p. So these are high valuations. So even now, when we are talking about the broader market, in the mid and small caps, valuations are elevated, valuations are high. That's why during the last 1 year, while Nifty delivered 9.5% return, Nifty small cap delivered only minus 8.5% return. It makes a huge difference, particularly in the case of retail investors whose portfolios are dominated by small caps, and sometimes even by cats and dogs, which always deliver negative returns. But the difference when we talk about mid and small caps is that the mid caps have earnings growth tailwind. They have been delivering earnings growth, but small caps have been disappointing on earnings growth also. So when you have a combination of high valuations and dismal earnings growth, market will punish. And that is what we are witnessing now. Even the best small cap mutual funds, which delivered spectacular returns during 21 to 24, are delivering negative returns if you take the last 1 year. So in the medium to long run, there will be reversion to mean, what we call the reversion to mean. That will happen, right? And retail investors, particularly those who entered the market after the COVID crash, they don't know much about these valuation parameters. That is why they buy stocks at 150 PE. They apply for IPOs coming with a PE of 230. It may be a company with, let us say, 20% revenue growth and profit after tax growth for the next 3 years, 5 years, 7 years, but you are not going to make money when you buy a stock.
People are blindly investing into IPOs without even looking at the value.
No, without looking at the value. It has become mainly a flipping game. You are applying for listing gains, but sometimes lifting
It has become pure speculative place, right?
Speculation is a mild word. I would say gambling.
We don't use that.
Yes.
But it has become
gambling. I am not happy about that. And also that has contributed to the dismal performance of the market, secondary market also.
Right. Yeah, a lot of money getting diverted.
Exactly. A lot of money is going there. Therefore, the incremental money net coming is slightly negative because a lot of money is going there. So we need a moderation there that will help the secondary markets also. So this is my view about the valuations across market caps.
We've always been talking about the success stories of the SIPs, the retail SIPs, which have always offered good support in the recent 1 year. Even though we witnessed FII outflows, the domestic inflows were there to support the markets. But maybe over the last 2 to 3 months, we've seen a slight disappointment, in terms of the retail inflows. SIPs definitely still remain a good, investment option for retail investors. What would be your suggestion to them in the sense that, we've seen a little bit of reversion in the sense people have started coming out of SIPs because, they've not, happy with the returns, if I can mention that. FII flows have continued. Of course, over the last 3 days, we've seen inflows coming in. Outflows have also determined the market, this thing. Where do you see these inflows, outflows balancing out?
It will depend on the performance of the market. We have seen that earlier also. We have seen that in 2000. We have seen that in 2008. We have seen that in 2013. I think we saw that in early 2020 also after the COVID crash. That will be a psychological reaction by the retail investors. But I am more focused on and happy about the steady growth in SIPs. As you mentioned, I think the last 4 months, monthly SIPs have actually recorded about 36,000 crores.
Yeah, around that. Yeah.
So slightly above that. So 36,000 crores coming every month. And it is not showing much volatility. Okay. There is volatility in other segments. Okay. But this is showing healthy trend, and that is the most desirable thing. Investors should be investing in SIPs without bothering about the time, without bothering about what will happen next month, 2 months, without bothering about what Donald Trump will say.
Pure long term.
Yes, pure long term. That will deliver excellent returns. That is our experience. There are funds which have delivered. I'm not talking about top performing funds. Even average, if you take, there are funds which have delivered 15% returns if we take the last 20 years. There are some mutual funds which have delivered 19.5% CAGR during the last 30 years, resulting in phenomenal wealth creation. But that will happen only if you are a long-term investor who invests with a lot of discipline through systematic investment plans. So in one sentence, SIPs should continue. You can choose your appropriate SIPs in which asset, which category. That is important. I told you.
Depending on the risk appetite,
depending upon the risk appetite and also about the valuation.
Valuations, yeah.
Because during, as you yourself mentioned, about a year back, we suggested caution in small caps. In a subsequent video which I said, I even went to the extent of saying that investors can even reconsider SIPs and small caps and switch to SIPs in partly mid caps and predominantly in large caps. Right? Because when valuations become highly elevated, well, when even SIPs will not deliver for a short period. In the long run, there is no problem at all. If you have a 3-year time horizon, it is not an issue. A very prominent fund manager in India, whom I respect quite a lot, I'm talking about Shankar Narayan, who he even very courageously spoke in a conference, and that was live forecast also. Went viral. He said, sell your small cabs, lock, stock and barrel, because there is no logic for this kind of irrational valuations. These are people with decades of experience and men of integrity advising investors what to do. So the time is, more than the time, valuation also is significant, but more important is the discipline that you put in your...
The story with the SIPs.
Yes. You should be investing for the India growth story, not for 2026.
So let's look forward to 2026. In 2025, last year you had mentioned to follow a multi-asset strategy, wherein you had brought in other asset classes also. Looking forward, would that still be the case? Would you want to look at multi-assets, not just equity, but other asset classes also, just to balance out the risk? Would that be a strategy for 2026 too?
Well, during 2024 and 2025, in 2025, with more focus, we suggested multi-asset strategy, because our message was expect moderate returns from equity. If you are expecting only moderate returns from equity, well, there should be decent exposure to other assets like gold and also to debt. And investing in debt, I'm talking about particularly what I have broadly in my mind is debt funds and hybrid funds, aggressive debt funds like that. That investment will be the right kind of investment at the early stage of a rate cutting cycle. Okay. When the rate cutting cycle begins, actually you should anticipate that and start investing earlier. Yeah. Then the bond prices, when interest rates come down, bond prices go up, and bond debt funds will deliver. And it was easy to anticipate that, because last year we knew that the RBI will...
They had to come out with...
Yes. So, of course, we did not expect the kind of steep rate cuts which Sanjay Malhotra and the Monetary Policy Committee delivered, but then that was anticipated. That is why we suggested. Gold, we knew it would perform, but frankly, I have to be honest here, I did not expect the kind of spectacular returns which gold delivered. This year, I would suggest a slight tweaking of this strategy. You can broadly continue with a multi-asset strategy broadly, because putting all your eggs in one basket would be a wrong policy. There are other asset classes also, alternate investments, for instance, which you can think about. Experts like you can make recommendations on that. But broadly, this can continue. But the tweaking that I would recommend is your exposure to equity should increase in 2026.
That is in line with your overall equity market outlook also, wherein you
exactly
went to decent expectations.
Yeah, from moderate. Yeah. So increase the exposure to equity, because equity is likely to outperform.
And would that be into the large caps more rather than...
Predominantly in large caps. Predominantly in large caps, which are from the valuation perspective safer, and from the potential earnings growth also, they deliver a lot of potential for earnings growth. Debt funds are not, we are at the trough of the rate cutting cycle. Another rate cutting cycle is a remote possibility, because personally I believe the economy, which is firing on all cylinders now, doesn't need a monetary stimulus. So it doesn't make sense to...
even the previous rate cut also, a lot of people said they did not expect it.
Yes, it did not expect. Majority did not expect. But the RBI governor, Sanjay Malhotra, is a pro-growth RBI governor, very unconventional also. He has done a great job. not a good job, a great job, no doubt about that. So since we are at the trough of the rate cutting cycle, don't expect the bond funds to perform. Of course, you can think about dynamic bond funds. So reduce the exposure there. Bank deposits, and also that's a different category.
It is a diversification option.
Diversification, right. Gold you can continue, but don't expect the kind of returns that you got last year and 2024 from gold. In the long run, you can expect 10% returns, but not very spectacular returns likely in 2026.
Specifically speaking about themes and sectors for 2026, I think 2025 was more about the consumption theme because, of course, it was supported by a lot of government policies. Sectorally also, we saw demand from the banking sector. Of course, IT was a bit mixed because of the policy, the US policy decisions and all that. What do you see for 2026? What are the themes that can play out, and the sector rotations that can happen? What do you think for 2026?
This is the tough part. Since I've been doing.
No, you've been scoring well the last couple of years. So let's.
So let me reverse this question to you. I will supplement. What, in your view, are the top sectoral picks which you are thinking about and which you are recommending to our clients?
No, see. So personally, I think there will be a continuation of the theme that we've seen for 2025. Is my opinion, wherein we will see a lot of the banking sector stocks continue to perform. Of course, even we are focusing on the consumption theme because there are a lot of opportunities over there. FMCG, yes, it has been disappointing, and it might not meet the kind of expectations that people have it. So even from a point of view, I think banking, auto sector,
banking plus NBFCs, financials, everything, financials broadly,
auto sector, and of course, specific place in the consumption theme would be my option. So what?
I broadly agree with your view there. There is unanimity of views. I will explain it a little bit in simple language for the lay investor. So when we are talking about financials, we are talking about the leading banks, the leading NBFCs, and in NBFCs itself we have a large number of categories, and then we have the capital marketplace in financials also. So it's a very broad thing. This should be the top pick. Particularly in banking, the fundamental favorable factor is economy is doing very well. Growth is robust despite the Trump tariffs. And when growth is good, credit growth will be good. Credit growth will pick up. There is demand for credit growth, which is improving. And banks are flush with funds, they have money to lend. And RBI is also, supporting credit growth. The earlier regime was a little bit fastidious about credit expansion. They introduced some controls also on some categories of lending. But now the NPAs of banks are very low. The balance sheets of banks are very strong. So credit growth will happen. And therefore, the sectors that will benefit out of that will be financials. In consumption, I broadly agree with your view. So I would put it more succinctly and say that in FMCG, you will not get a disproportionate growth, because when there is a GST cut, when there is an income tax cut, as your disposable income increases, you will not buy more soap.
Right.
You will not buy more shampoos.
That's right. Yeah.
But you will buy, perhaps a person who does not have a motorbike will think of buying a motorbike, an electric scooter, or a person who has a scooter or a bike may think of buying an entry-level car. A person who has an entry-level car might think of buying a higher-end car because the GST has come down, the price has come down, credit cost has come down.
Basically essential and non-essential.
Yes, it's a discretionary consumption. To put it in very simple language, discretionary consumption is the consumption that has picked up and likely to sustain the growth momentum going forward. So in discretionary consumption, automobiles classify. Then of course there is categories like travel. In spite of the mess which Indigo did, that is one segment which has tremendous growth potential for many years to come. Then hotels are doing exceedingly well. The problem is that enough hotel rooms are not available for business travelers. So these are all examples of discretionary consumption. Again, when your disposable income increases, you may buy more jewelry. Right. So there are stocks like Titan, for instance, which is a classic example of discretionary consumption. So that is what investors should be thinking about. So one point that I would like to add here, I had mentioned this in our last year interview also, and that is investors should be focusing on the mega trends happening in the economy. Major trends. One mega trend is this platform companies, digital platform consumers facing companies like old Zomato, right, now called Eternal, Swiggy. Right. Then there are the companies like Nykaa, Policy Bazaar, PB Fintech, a host of them. Even when the economic growth
recent IPO of Misho.
Yes, recent IPOs, but you have to be careful about the valuations. But then at least some of these companies will grow at 25 to 30%, not for 2 years, 3 years.
So that is a shift that we've already witnessed, or we are witnessing?
We are going to witness it for many, many years to come. This is a decadal shift, not a shift for a few years. The market will discount what is likely to happen 3 years from now, 4 years from now, but not what is likely to happen in 2036. Right? Market has its limitations also. So if you ask what will be the sales turnover of let us say Eternal, particularly Blinkit, well, the figure can be a mind-boggling figure. And if their profit margins also steadily increase, well, this is a decadal.
So we are yet to see that explosion.
So this segment, we had mentioned it more than a year back. I think some of the stocks have been mentioned in the interview which I did with Abhilash. Okay. Many stocks, and some of the stocks have multiplied 3 to 4 times in 3.5 years. So picking at them at the right time can lead to a fortune. Another mega trend is this financialization of savings. Yeah. People of my generation, not me, but people of my generation were savers, putting money in bank deposits, right, mainly, and people of the present generation, youngsters, and also many of the middle-aged guys are investors, not happy with the dismal returns which they are getting from the bank. Traditional asset classes. So they have become investors, not from the savers, and therefore the capital market is growing by leaps and bounds. So this category which we can include under financials, capital market linked themes. So you have got stock exchanges there.
Yes. You got intermediaries over there.
We have got depositories there. We have got asset management companies there. We have got wealth management companies there. And all of these companies, some of them are top players. They are all listed in the market. They will continue to grow. I'm not talking about 26, 27, 28. They will continue to grow for next 5 years, 10 years. And when this theme grows big and matures, market partly has discounted this growth, right? And that is why some of them are quoting at what appears to be now prohibitive valuations, but in hindsight they may not be. That may not be. So even while we talk about sectoral themes for 2026, at the back of our mind we should have these big themes which are emerging for the next decade.
Well, Dr. VK, thank you very much. So as your parting gift to the investors, what would be your last words for the year to the investors watching this session?
Well, my parting message would be continue with systematic investment plans. Give importance to valuations. Don't buy shares, particularly newly listed shares, at the prohibitive valuations. The companies may be good, but if you buy at very high valuations, they will disappoint. The market will disappoint. The stock price will disappoint. Therefore, give importance to valuations. Give importance to safety. I always believe in the dictum that return of investment is more important than return on investment. So even if your return on investment is 1 or 2% less, don't be disappointed because your money is very safe.
Right.
So continue with a healthy, systematic investment with a long-term view. Look beyond the 2026 and believe in the India story, India growth story, and profit from the India growth story.
Thank you, Dr. VK. So there you have it, year 2026, filled with a lot of opportunities, but a lot more challenges also. Investors need to be vigilant about the fact that even though the strong fundamentals, the domestic fundamentals offer a strong backup to the Indian equity markets, they still need to be aware of the global uncertainties that can come along with this. The message is simple: be disciplined, diversify your investments, and invest for the long term. Here's wishing all of you a very happy New Year 2026 from all of us here at Geojit Financial Services.
Happy New Year and happy investing. Thank you.